Silver trades at $47 an ounce on paper screens, down from $54 just weeks ago, while physical bars vanish from vaults at premiums, spiking 40% above spot. COMEX outflows hit 58 million ounces in October alone, a 314% surge, draining inventories to levels not seen since 2017 in Shanghai. LBMA's free float collapses to 10 to 30 million ounces, against daily paper trades of 700 million, a leverage ratio screaming 400 to 1, where claims outstrip metal by orders of magnitude. This isn't volatility, this is fracture. The system designed to price scarcity through infinite promises just seized, and the correction meant to crush demand only accelerated the drain. Right now, as exchanges open, bids evaporate not from fear, but from absence. Metal moving east, locked in industrial chains, leaving paper holders staring at blanks. The mechanics held for decades. Bullion banks like JP Morgan and HSBC stack short positions equivalent to 60 billion ounces, dwarfing global annual production of 850 million. They hedge miners, lease to users, collect premiums on volatility they engineer. But in 2025, the script flips. Open interest drops during rallies. September to October saw substantial declines in both gold and silver contracts, signaling not profit-taking, but forced covering. Shorts scramble as physical deliveries rise 1%, enough to trigger defaults in a system balanced on 99% cash settlements. Here's the break. Historical interventions, like the 2011 margin hikes that nuked prices 40% overnight, now fizzle. On December 12th, CME jacked requirements 50%, expecting a cascade sell-off. Price dipped, held, rebounded. No panic. The kill switch activated and misfired. Trace this back through the layers. Industrial demand clocks 680 million ounces in 2024, up 4%. Projected flat into 2025, but structurally unyielding. Solar panels alone consume 197 million ounces. EVs and data centers pile on, turning silver from asset to input. Consumed, not recycled at scale. Recycling hits 194 million ounces, a 12-year high, yet deficits run 149 million ounces annually, totaling 800 million over 5 years. Mine output edges up 2% to 835 million ounces in 2025, but ore grades fall 7% year over year. Underinvestment bites as costs drop 13% to $14.58 per ounce, all in sustaining. The math doesn't bend. Supply peaks 2026, then slides without fresh capital that high prices deter by design. Now, layer in the silence. Regulators watch as CFTC reports vanish for 6 weeks during the U.S. shutdown. Opacity peaking. Just as LBMA scrambles emergency shipments, 58 million from COMEX, chunks from Switzerland, Shanghai contributions. No headlines scream ban, but whispers build. Limits on new shorts, cash-only mandates, temporary halts. Banks assess retreat, preserving capital over liquidity provision. If you're tracking exchange volumes or vault reports, you've seen the bids thin. Write in the comments how this opacity plays out in your feeds, whether it's deliberate signal or just breakdown. This echoes the quiet endings of past cycles, where systems age into rigidity. Think 1929. Institutions reward compliance until leverage exposes the hollow core. Effort pours in, but outcomes stall because rules tied to an expiring era. In silver, the old playbook, suppressed through paper floods, worked when demand was elastic, investor speculative. Now, buyers shift. State-linked entities, industrials securing long-term agreements, removing metal from trade pools. India imports 1,600 tons in October, up 529%. Not for flips, but fabrication. The ratio skews. Gold-silver at 75 to 85 to 1 against historical 16 to 1. Underpricing silver as deficits compound. Pressure reveals the pivot points. In stable phases, wealth accrues incrementally. Buy-hold thrives, loyalty pays. But at cycle closes, like the 1970s stagflation or 2008 trust evaporation, gains turn asymmetric. Those positioned early, sensing the ground shift, outperform decades of late effort. Silver's lockup isn't isolated, it's the canary. Debt cycles strain. Central banks hoard 39 tons of gold in September alone, indirectly propping silver tails. Yet silver's industrial tether makes it brittle. Unlike gold's pure store, it's burned in circuits, panels, munitions. When paper decouples, premiums explode, creating parallel markets. Spot stalls at $47, physical trades $65 plus in shadows. Here's where logic fractures further. The margin nuke on December 12th aimed to trap longs, liquidate specs, restore control. But strong hands absorb. Industrial orders auto-buy on dips. No emotion. Price holds support. Bounces, defying the chain reaction. Anomalies stack. Backwardation sets in. Spot over futures. Lease rates at 40% screaming desperation for bars. This isn't growth. It's rupture. Banks, facing existential exposure, step back. No buying, no selling, capital hoarded. The kill switch, once a reset button, now accelerates the unwind as physical scarcity overrides paper commands. Cycle endings don't announce with sirens. They slip in while routines distract. Every 80 years, societies reset. Institutions weaken. Confidence fades. 2025 marks the fourth turning's close, where old rules punish rigidity. In silver, the transition shows raw, from compliance rewarding paper plays to adaptability demanding physical hold. Those who notice early don't look smart initially. They seem cautious, stacking bars when screens flash sales, but time compounds their edge. If you've repositioned assets amid this drain, share in comments how the physical paper gap manifested in your transactions. Did premiums confirm the break, or was it vault access? Wealth never blooms in comfort. It accelerates in imbalance. Stable eras compress returns. Everyone knows the game. Uncertainty gaps it out. Fewer act. Pricing favors the clear-sighted. Silver's surge, 102% year-to-date. ETFs at 127% average. Outpaces gold's 59%. Yet manipulation claws back. October's $54 peak corrects to $47, but rebounds signal resilience. Why? Buyer profile evolves. No longer retail chasing highs, but entities with irreversible needs. This hesitation from specs creates the opening. Act in fog. Gain leverage lost to clarity's arrival. Effort misaligned evaporates. Positioned, it multiplies. Paddling upstream drains. With current, momentum builds. In silver, upstream is clinging to paper claims as vaults empty. Alignment means recognizing the eastbound flow. China plus 7% industrial pull. India duty cut spiking imports. The system's loss of elasticity. Deficits no longer masked by hedging. Book down 49% to 4.5 million ounces, lowest in decades. Forces the question, where does effort compound now? Not in waiting for CFTC clarity, but in auditing exposures before the next halt. Flash fades when tested. Resilience endures. Silver's crisis tests the flashy. Over-leveraged shorts, hype-driven specs. Margin hikes expose them, but resilient holders, those with buffers, diversified beyond paper, bend without breaking. Flexibility here. Pivot to physical. Monitor COMEX bleeds. 12.5 million ounces in one day. Anticipate backwardation spread. The psychological anchor. Identity untied to single outcomes. Viewing dips as signals, not failures. Consistency trumps brilliance in transitions. Small repetitions. Monitoring inventories. Accumulating on corrections. Reshape outcomes quietly. While specs overthink, consistent actors move. Read reports as others scroll headlines. Invest amid pullbacks as others panic. Silver's patterns reward this. Rallies with declining open interest. Corrections that hold floors. Over cycles, this discipline outpaces clever one-offs. Risk of inaction compounds silent. Standing still in silver's thaw costs. Hesitation lets premiums climb, access tighten. Not acting preserves illusionary safety, but misses the repricing. Calculated moves, testing physical holds, scaling in. Reduce downside, preserve upside. Fear examined becomes data. Unchallenged, it stalls. New eras reward vision over obedience. Silver demands seeing beyond spot ticks. Unmet industrial needs, emerging scarcities. Skills like analysis, adaptability travel cycles, leverage via networks, tech scales impact. Those evolving quietly, redefining from trader to holder, gain as hierarchies flatten. Preparation in endings, seeds, leadership in beginnings. While others mourn stability, the aware build. Emergency buffers against halts, consistent investments defying nukes. Relationships forged in uncertainty endure. Options create calm. The invitation hides in the lockup. Not loss, but realignment. The gap widens in silence. Those noticing early, vault drains, ratio skews, adjust before crowds. Awareness buys time. Time buys power. In silver, it's the farmer prepping soil as frost hints, not shocked by cold. Comfort dulls. Pressure clarifies. Silver squeeze strips waste. Inefficient hedges collapse. Weak strategies expose. Simplification follows. Prioritize physical flow over paper returns. Adaptability over certainty. Timing directs effort. Silver's misalignment. Effort in shorts evaporates as physical pulls. Highlights. Place energy where growth begins. not ends. Early movers in 2025's Turnin appear lucky. Really, aware. Rules expire without notice. Silver's old guarantees. Liquid paper, predictable interventions. Fade, confusing adherence. Adaptation, question assumptions. Evolve practices while principles hold. Resilience over display. Silver's test. Structures crack under leverage. Flexible ones recover. Emotional stability decides. Calm execution amid blanks trumps reactive swings. Consistency reshapes. In silver's volatility, daily vigilance. Tracking premiums, deficits, compounds into dominance. Boring actions sustain. Intensity fades. Inaction's cost mounts. Silver's hesitation amplifies gaps. Missed repricings, reduced options. Movement protects. Stillness erodes. Values shift. Vision, skills, leverage rise. Silver rewards seeing scarcity early, building independence. Endings invite reinvention. Silver's freeze forces choice. Cling or prepare. Quiet builders lead the next phase. If you're in mining or supply chains, detail in comments how these deficits hit your operations. Does the 150 million ounce gap feel like the turning's edge? The system's heaviness mounts. Institutions slow. Rules outdated. Silver exemplifies. Progress hardens despite inputs. Acknowledging requires responsibility. Ignoring eases, but costs. Advantages to early noticers. They save as others spend. Learn as others distract. Silver's early stackers watch premiums confirm their edge. Danger in assuming permanence. Silver's stability illusion shatters with floats at 10 million ounces. When rules reward adaptability, loyalty falters. Awareness separates. Feeling out of place in silver's disconnect? Signal of shift. Use it. Identity recalibrates. Silver forces. Let go outdated strategies. Ask what new normal rewards. Leverage in physical, networks. Action shifts. Audit exposures to paper. Build buffers against nukes. Invest consistently. Mindset protection. Fear spreads. Facts ground. Silver's history. Collapses seed expansions. 2025. End of passivity era. Position for forward motion. Regardless. Years later, this lockup marks the point. Regret or pride hinges on choice now. But dig deeper into the fracture lines. The gold-silver ratio at 85-1 isn't arbitrary. It's a distortion baked in by decades of suppression. Historical averages hover 16-1 because geology dictates. Silver, 17 times more abundant in crust. Yet paper mechanics invert this, undervaluing silver to prop gold's narrative as pure haven. In 2025, as industrial pull consumes 460 million ounces in electronics alone, the ratio's lie unravels. Backwardation isn't anomaly, it's confession. Spot premiums admit the paper floor crumbles. Connect this to geopolitical threads. India's 51 million ounce October binge isn't consumer whim. It's strategic. Duty cuts aligning with rural recovery, but timed amid global drains. China exports 136 million ounces. Record, yet domestic demand plus 7%. Hoarding for AI grids, EVs. US. Tariffs loom, exempting silver, but spiking EFP premiums, $1 per ounce in fear. Metal air freighted to CME. 100 million ounces shifted London to US vaults. This isn't trade. It's repositioning before borders harden. The regulatory vacuum amplifies. CFTC's 6-week blackout during shutdown. Commitment of traders reports absent as open interest plunges. Coincidence or cover for covering? Enforcement history. JP Morgan's 2020 spoofing conviction. Trader jailed, yet positions persist. Rules change not in laws, but margins. December 12th's 50% hike. Overnight, no fanfare. Intended to force $67 triggers unwind, where shorts squeeze at that threshold. Reddit threads buzz with confirmation. $67 as pain point. Kill switch activating crisis. But price holds $47. Climbs back, because the chain breaks. No more week longs to liquidate. If you followed the $67 discussions or seen squeeze signals in your charts, interpret in comments. What makes this threshold the system's weak link, and why did it hold this time? Layer military angles. Silver's dual use, munitions, electronics and drones, missiles. Demand spikes with tensions. Middle East, elections fueling uncertainty. Central banks buy gold, 39 tons September. But silver's industrial tie makes it stealth strategic. Export controls whisper. China tightens. US eyes critical minerals designation. This isn't market, it's logistics war, where physical chains trump paper. Historical mirrors sharpen the view. 1980. Hunt Brothers squeeze. Prices to $50. Then crushed by rule changes. Margins tripled, trading halts. Worked then, because buyers were speculative. 2011 redux, $49 peak, nuked 40%. But 2025? Industrial base inelastic. Solar installs 278 gigawatts in China, each panel burning silver irretrievably. The mechanic that worked fractures because the system's elasticity eroded. Deficits since 2021, 820 million ounces short cumulatively, turned temporary squeezes into structural. The turning's logic: old systems reward trust until they don't. In silver, trust in paper settlement, 99% cash, 1% delivery, held until deliveries tick up. Now, 1% strains vaults to breaking. Where stability punished awareness, transition rewards it. Those sensing the ratios lie, the deficits bite. Position early. Physical over futures, resilience over returns. Uncertainty's test ground. Silver's parallel markets emerge. Paper drops, physical premiums 40%. Those acting thoughtfully, scaling into bars, diversifying beyond COMEX, gain as competition retreats. The collective hesitation, banks stepping back, creates imbalance for the prepared. Efforts redirection. In silver, pushing paper shorts exhausts, aligning with physical flow multiplies. Timing. Enter before clarity, as 54 correction proves. Rebound catches latecomers flat. Rules transformation. Silver's guidelines expire. Buy-hold fails in volatility. Adaptability wins. Confusion traps the rigid. The flexible reposition. Resilience is proof. Silver's storm. Flashy specs crack. Anchors hold. Flexibility. Pivot to off-exchange deals as liquidity thins. Consistency's power. Daily silver vigilance. Premium checks, flow tracks. Compounds into edge over sporadic brilliance. Inaction's trap. Waiting for silver's clarity misses the premium climb. The access lock. Visions rise. Silver demand seeing needs ahead. Industrial surges, geopolitical hordes, preparations dividend. In silver's ending, build buffers, networks, lead the physical beginning. If you're in finance or trading, write your take on the margin nuke's failure. Does it signal the cycle's close, or just a pause in control? Push the analysis further. Producer hedge books at 4.5 million ounces, down 49%, lowest ever. Miners refuse forward sales, betting on upside. Why? Cost dropped to $7.64 per ounce cash. Byproduct credits from gold, plus 22%. Zinc plus 21% cushion. But investment lags. ETPS up 6%, yet coin/bar down 22% to 191 million ounces, 5-year low. West weakens, US minus 46%, while India plus 21%. This bifurcation, retail flees volatility, institutions tactical enter. Geopolitics interweaves, Trump rollbacks speed US permitting, but Mexico's open pit review threatens 27% supply. El Salvador lifts ban, adding potential, but thrifting risks. PV loadings down 20%, composite substitute. Anomalies here. Streaming output up 5% to 36.7 million ounces, Wheaton dominant. Yet overall underinvestment signals peak production 2026. The system's loss of control manifests in flows. UK exports plus 12%. US imports minus 12% to 15-year low. Tariff fears drive air freight. Premiums spike. This isn't efficiency, it's scramble. Cycle parallels. 1930s depression buyers positioned for reset. 1970s inflation builders leaned into scarcity. Silver's 2025 mirrors. Uncertainty sharpens, comfort dulls. Those chasing paper certainty miss the physical pivot. Wealth in transition. Asymmetric gains from early decisions. Silver's 127% ETF returns aren't luck. They're positioning ahead of deficits. Misplaced effort. Specs and shorts burn out. Aligned in physical, momentum builds. Expired rules. Silver's liquidity illusion shatters with 140 million ounces available against 700 million traded. Strength. Beneath. Silver's resilient holders weather nukes, flexible adjust allocations. Repetition's quiet force. Consistent silver accumulation outpaces timing attempts. Stillness is danger. Inaction in silver lets gaps widen. Opportunities move on. Recalibrated values. Vision spots silver's underprice. Leverage scales holds. Hidden invitation. Silver's lockup reinvents. Prepare quietly, emerge leading. If you've experienced parallel pricing or premium spikes firsthand, share in comments your interpretation. How does it tie to broader system strain? Extend the threads. Photography demand down 7% to 25.5 million ounces. Multi-decade low. Digital erodes. but brazing alloys up 3% to 51.6 million. Other industrial plus 4% to 168 million. Geography matters. China to Hong Kong, 6,500, 77,000 tons electrical, up 8%. US, down 6%. This unevenness, West's weakness amplifies drains, East's pull sustains deficits. MCA surges, 32 deals, $3 billion, highest since 2006. Kerr buys Silvercrest for $1.5 billion, adding 4.8 million ounces 2025 output. Consolidation signals scarcity awareness. Legislation's bite. Mexico's pit ban review. 88% byproduct at risk. U.S. faster permitting counters, but tariffs exempt silver. Yet fears moved 100 million ounces. Recycling anomalies. E-scrap yields decline. PV panels unprofitable. Limits offset to deficits. Forecast fractures. 2025 deficit, 118 million ounces, down 21%, but supply plus 2%. Demand minus 1%. Risks. Tariffs flatten industrial, thrifting in auto/PV. Price outlook. Upside from rates, geopolitics. Gold. Silver approximately 90 to 1. Potential compression. The turning's weight. Silver is mirrored to erosion. Debt fragility, power decline. Rules bend to preserve, but breaks reveal. Early leverage. Notice silver's signals. Ratio, deficits. Adjust before obvious. Permanence is illusion. Silver's stability crumbles with inventories. Out-of-place feeling. Silver's disconnect cues action. Identity shift. Silver redefines success. From paper gains to physical security. Financial audit. Trace silver exposures. Buffer against halts. Mindset guard. Silver's panic profits media. Facts show seeds of repricing. Passivity's end. 2025 demands positioning. The point remembered. Choice defines. But the narrative coils tighter. LBMA's October blackout. No trades, screens blank. Not crash, but seizure. Free float 170 million ounces by November. 20% of vaulted 844 million. Rest locked. ETFs, allocated, claims. One way east. Shanghai stocks 39 million. Decade low. COMEX 25.3 million. After single day 12.5 million bleed. Bitcoin negative. YTD. Silver plus 95%. Flight to tangible. Lease rates 40%. Market pays anything for bars. This structural. Mine peaks. Recycling capped. Demand irreversible. Interventions evolution. From direct spoofing to subtle margins. Halts. If you're analyzing historical squeezes like 1980 or 2011, comment your view on why 2025's differs. Does the industrial base make suppression unsustainable? Geopolitical weave. Middle East tensions spike military use. AI grids, EVs burn silver. Central actions. Gold buys indirect, but silver's criticality whispers, controls. Hedging low, miners bet up, book 4.5 million. Cost down, but investment needed. Underinvestment risks post-2026 drop. Thrifting threats. Composites cut loadings, but demand outpaces. MCA as signal, consolidation for reserves. Legislation, bans lift, reviews threaten. Flows, exports records, imports bifurcate. Anomalies, ETPS up, coin down. Forecast, deficits persist, prices rise. The cycle's close. Silver's fracture a symptom. Systems crack, new reward prepare. Asymmetric in uncertainty. Silver's gaps favor early. Alignment over force. Silver's flow east. Transformation. Silver's rules fade. Bend, recover. Silver's resilience. Compound behavior. Silver's vigilance. Examined fear. Silver's data. Rise vision. Silver's needs. Seed lead. Silver's preparation. If you see this as the fourth turning's end manifesting in commodities, write your observations in comments. What other signals align with silver's break? The heaviness settles. Silver's silence before recognition grows. Preparation compounds. Gap widens. The next era forms. Opportunity shifts to the awake.